I mean, obviously,
Oh
people
yeah,
say,
no, I'm not sure how deep the market will go. I mean, you could go back and look at history, 29 to 32. I mean, it's like an 80% wipeout ultimate. And it began with a crash and then came all the way back up, halfway back up into March of 1930, and then went down slowly for 2 years, but an 80 something percent drop. And it took until 1953 to even get back to the nominal price high the Dow saw in 29, not counting the degradation in the money unit. Similar thing happened in 2000, by the way. People think, oh, wow, the stock market made a low in 2002. Great. But in 2013, for the S&P to finally take out those highs, the 2007 highs and the 2000 highs. So you had a decade and a half almost where the market was a wasteland, really, in a range. Anyway, I think we're headed into that, and I think there'll be real world consequences. And one thing we said about a year ago is we thought, well, if Trump wins, a couple things are likely to happen, but one of them is likely to be uncopacetic in terms of public response. And I mean, the opposition, rather than sitting back on their haunches and waiting for the next election cycle, I suspect if we get economic downturn now that is noticeable to the average Joe, something he thought Trump wouldn't bring on, Trump is going to save the economy. Well, if all of a sudden that doesn't happen, then emotions come into play. Sense of uncertainty. And when that happens, and we know people are hurting on their credit card limits and so forth and so on, we know these data points. We know commercial real estate is in a stranglehold right now. In fact, we had the biggest shopping center in the country. I think it was an $800 million default on debt. 2, 3 months ago. Wasn't a headline, but it happened. That you can get uncopacetic things in the street as well.
okay. And by copacetic, you essentially mean civil unrest, correct?
Yeah. In fact, there have been polls done by University of Virginia Department of Politics about 2 years ago. It was they polled both likely Biden voters and likely Trump voters. If the other side wins, is violence justified? And it was an incredibly high percent, like 20 something percent on both sides. And yes. If the other side wins, is that the end of democracy? It was like a 40% odds on both sides. Yeah. In other words, this wasn't a normal election. We're at a point now, if you throw into the mix economic pain and suddenly a sense of disbelief, like, well, we thought, Trump got labor vote, he got to low income vote who thought this guy can probably solve our problem. He's sort of down to earth. And if all of a sudden that turns out not to be the case, not so much because of what he does or didn't do, it's what has already happened. He just stepped into it. If that unfolds, as we argue it's likely to, then a sense of emotional disbelief occurs. And that's when you get that uncopacetic, unpredicted outcome where all the norms aren't there anymore. And so that's another element that I think is probably we're going to see it this year, especially if we're correct on the stock market, relapsing from a new high, like it did, by the way, in 2007. You made a peak in May. Where was it? Back at the same price as the 2000 bull market peak, 1550 on the S&P. You dropped from May to August, a hard drop, just like we had January through April. Bernanke during that time denied that there's any problem with the mortgage markets. It's totally controllable, he said.
The subprime is contained. Yep.
Yes, right. You remember that. And the market turned up in August, September, moved back toward the high. And in mid-September, he cut rates by 0.5 point. Surprising rate cut, by the way. Was not anticipated. The market shot up for another 3 or 4 weeks into mid-October, taking out both the May high of 2007, just above 1550, and the 2000 high, just above 1550. It got up to 1575, like 1.5% into a new high. Fed rate cuts, everything's going to be great. That was the end of the world. We went to hell for the next 2 years.
Yeah.
And reality hit. We had a mortgage crisis. Now it's probably not a mortgage crisis so much as it's a corporate debt crisis and other issues. But same story. Don't be teased by a new high.
I believe that we have somewhere around close to $1 trillion re-rating this year and similarly next year. Is that when you expect a corporate debt crisis? Is that the main trigger? Is that the balance sheet is re-rating?
It's been a trigger. Yeah, it's been underway actually for a couple of years. If you've seen the movie The Big Short,
sure.
You remember they had 3 or 4 guys, separate parts of the country, analysts, independent of Wall Street, who came up with the same conclusion that shit's going to happen. Okay. In other words, this is built-in crisis. It's going to happen. They knew it was going to happen. They could see it coming.
Right. It's math.
Yeah. But look how frustrated they were. They were seeing this in 2005, 2006, 2000. It wasn't until 2008, even after the Fed cut rates finally, that it began. And they were right. So you can have that crisis. For instance, the long end of the bond market, the 30-year bond futures we look at. We got bearish on T-bonds back in October of 2020. Then the T-bonds were above 170. Between 2020 and late 2022, they dropped down into the 110, 115 zone. A huge collapse. A lot of it occurring late in 2022. But since late 2022, you can draw a line sideways on price, and you've done nothing but this. In other words, it's been in a choke zone in terms of yields really dropping. They haven't dropped. They've stayed high. And of course, the yield chart would show it the other way, up, at high levels.
Yep.
But it's not that they have to go higher to choke people. They're already choking. It's just that they won't relent. And as you said, maturity, 2025 and 2026, as I understand, is likely a time for a lot of these debts to be exposed in terms of the ability to pay or not. And so, we could be nearing that crisis. And yet it's been a reality that's been there for a couple of years. It just won't go away.
All right, let's just start by saying it. We're living in one of the most bizarre, precarious, and yet strangely overconfident economic times I've ever seen. If you're looking around thinking, this feels different, trust your gut. It is different. And it's not different in the sense of some marvelous technological revolution that's going to bail us all out. It's different because we've never ever in modern history stacked up so many layers of fragile debt on such a wobbly global monetary foundation. People like to compare every modern market concern to either the dot-com bubble or the 2008 housing crisis. Those are the two big cautionary tales people keep in the back of their heads. But I've got news for you. Those were mostly isolated bubbles in specific asset classes. The dot-com bubble was about absurdly priced tech stocks. The housing bubble was about mortgage-backed securities and reckless leverage on real estate. This time, the bubble is in everything. Stocks, bonds, real estate, consumer credit, corporate credit, sovereign credit, you name it. We are literally looking at a triple whammy of debt stress. On the consumer side, it's credit card balances at record highs, student loans creeping back into repayments, auto delinquencies ticking up. On the corporate side, you've got hundreds of zombie companies that only survived the last decade because money was basically free. And now, thanks to the fastest interest rate hiking cycle in history, their refinancing costs have doubled or tripled. Then you've got the sovereign side, the US government itself, which is running trillion-dollar deficits every year in a so-called strong economy. What happens when it actually slows? Here's the crazy part. The Treasury bond market is bigger than the entire US stock market. It's the backbone of the global financial system. That's what banks post as collateral, what pensions depend on for stability. And if you look at a chart of long-dated Treasury futures, the 30-year T-bond in particular, it's basically been screaming that something is wrong. Every attempt to rally in the last 3 years has failed spectacularly. Back in January through April of this year, bonds bounced from about 114 to 121. That's a meaningful rally. Everyone thought, finally, yields are coming down, the bond market's stabilizing, we're out of the woods. And then within 2.5 days, it collapsed back down to 111. That's not just a failed rally. That's a sign of structural rot. And it's the sort of move that should have central bankers breaking into cold sweats in private, even as they smile calmly for CNBC. Because remember, in 2008, the US Treasury market was still viewed as a safe haven. Stocks were tanking, real estate was tanking, but everyone piled into treasuries. This time around, you have to seriously question whether the global market has the same unshakable faith. After decades of compounding fiscal errors, and yes, that includes under Trump, under Biden, under Obama, under Bush, nobody's hands are clean here. The debt has grown so large that servicing it is on track to outstrip what we spend on defense and eventually Social Security. The CBO knows this. Their own forecasts show it. Even their optimistic scenarios still put us on a path to spending more on interest payments than on the entire US military by the end of this decade. So yeah, I think we're headed for a crisis that's going to be fundamentally different from the boom-bust cycles we're all used to. I get asked all the time, Michael, is this going to be like 2008? And my honest answer is, I wish it were, because that would be easier to model. In 2008, you could at least identify the bad loans. You could look at subprime mortgage portfolios and calculate how much had to be written down. Today, the problem is systemic. It's baked into the entire sovereign debt system. There is no single institution to bail out, no ring fencing a particular asset class. And by the way, this is not purely an American story. Europe's sovereign debt mess is arguably even uglier. Japan is a ticking demographic time bomb that's still printing like mad. And emerging markets are desperately trying to hold on to dollar reserves as the cost of servicing their debts explodes. This is a global sovereign debt bubble, and it's already leaking air.
Do we have the sort of triple whammy of
Oh,
debt
yeah.
stress, both on the consumer, the corporation side, and the national side?
And the national side too, which
Or the
is
sovereign side, yeah.
that's even bigger. And the T-bond market is, that's the government debt, okay? And you look at that chart and say, this guy has tried to get up out of here so many times in the last 3 years, get a rally going, drop rates, rally the price. And they've all failed. We had a good rally going, for example, back in Jan, Feb, March, April of this year. Bonds rallied from like 114 to 121 very sharply. Nice rally, and thought, oh boy, we're on our way, right?
Yeah.
Within 2.5 days, it was back down to 111. That's a crash. What happened? I mean, you can't do that with the government debt market. The central bank has to be panicked to the point of wetting themselves without admitting it publicly, of course. They thought, oh, everything's fine, Well, a government debt market is not. And so you now have a problem you didn't have in 2008. Now it's come to the fore. I mean, so many decades of this error compounding. And even Trump has increased the situation. The debt is increased under his budget. So they may be talking about it, as you said, but nobody's doing anything about it. I think we got a crisis coming, and it's not just stock market, but it's in the real world. And I think that crisis this time around, unlike 2000 to 2002 or 2007 to 9, is going to create the kind of changes and uncertainty and up in the hands type response by everybody. Like, what the hell's going on type thing, to where we're going to lose, which is fine with me, some institutions that have been around for 100 years. I'm betting you won't have a Federal Reserve, not because Trump doesn't particularly care about it one way or the other, and a lot of Republicans don't, but because it's dysfunctional. And there's a lot of people realizing it's really been a boom-bust cycle generator. Not just the Austrian School of Economics, but others are saying, this really thing hasn't worked well. They're always behind the curve, et cetera, et cetera. I also think if you see that pinching effect that you're talking about, or the choking effect of debt, particularly personal debt, income taxes are in question. Not so much because some Republicans just soon get rid of it anyway, but because it's dysfunctionality in terms of the source of government revenue, which it's become more and more every year in terms of the revenue that it generates, as what was expected is less and less. And there's a point at which people simply say, oh, I have to request a delay, or, oh, I need a plan. I'm driving around town and I'm listening to Sirius Radio, whether I turn on CNN or Fox Business News or whichever. There's constantly ads about, we can help you with the IRS. That's like 50% of the ads. Well, I didn't know there was a problem. Yes, I do. But I mean, that could be the kind of crisis where all of a sudden income taxes are abolished. Not so much because they intellectually like the idea to do it, it's just that it's dysfunctional, and they revert to a national sales tax. Let the shopkeeper collect taxes for the government. All these kind of changes could occur, and I don't think there'll be a surprise. There'll be a surprise for many, but I think this is different this time. I think the world, it's not just the US, I think a lot of countries are going through major change, or about to, especially if we enter the kind of crisis we're talking about with the stock market down. The data points will go with it. Day-to-day life will change, much like it did in 2007 and 8, if you recall.
So think about this, folks. This is really the meat of the discussion. We're living in a period right now where everyone's got their eyes on stocks, or crypto, or Tesla, or whatever the hot narrative of the day is. But the real rot, the real systemic cancer, is underneath it all in debt markets. Consumer debt, corporate debt, sovereign debt, all converging. And it's become so huge that it dwarfs even the panic cycles we used to live through. People keep asking me, Michael, do you think it'll be like 2008 again? And I have to sort of darkly laugh because in many ways it's worse. See, in 2008, it was primarily the mortgage-backed securities and over-leveraged banks blowing up, right? It was contained in a perverse sense. Now we have that plus an even bigger problem: sovereign debt that's metastasized out of all proportions. People want to imagine that we'll get some replay of the same movie. They like the comfort of a familiar disaster. But this isn't just a sequel, it's a whole new genre. The sovereign bond market is the last pillar of the entire financial architecture. It's what all collateral references. It's what banks use to shore up their balance sheets. It's what pension funds lean on to ensure your grandmother gets her check. And it's cracking. Just look at the T-bond charts. We tried to get a rally going this year, a classic relief wave from 114 to 121. Looked promising for a minute, then within 2.5 days it puked back to 111. That's not normal. That's structural fragility in the biggest bond market on earth. And when you combine that with what you just pointed out, the re-rating of corporate debt, it's almost mathematically guaranteed we're heading for turbulence. Think of all the companies that gorged on ultra-cheap money for the last decade, rolled over short-term paper, floated debt at laughable yields, and now suddenly face refinancing at 2 to 3 times the old rates. That hits earnings, that hits stock prices, that hits employment. And that's before you even layer on consumer squeeze from higher credit card APRs and decaying wage power. This is how the snake eats its own tail. And you know what? It's not even speculative anymore. It's already happening in commercial real estate. Look at Blackstone letting properties go. Look at Brookfield defaulting on downtown towers. It's the biggest players in the world quietly handing back the keys because they did the math. They're not emotional. They see that at these higher rates, the asset is worth less than the debt it carries. That's the ugly reality starting to spill out. The same thing is coming for zombie corporations that only ever existed because money was free. People also forget the stock market is often the last to get the memo. Go pull up charts from 1929. You see that initial crash, then a massive rally, and they call it a sucker's rally, all the way up into 1930. Everybody's breathing sighs of relief. Phew, that was close. We're back on track. And then the slow, grinding destruction for 2 more years, down 80% from the top. It took until 1953 for the Dow to recover its nominal high. Nominal. In real terms, factoring the loss of purchasing power, it never did. Or look at the 2000 tech bubble. Market bottoms in 2002, sure, but it wasn't until 2013 that the S&P consistently broke above those old highs. That's 13 years of dead money. And guess what happened in between? People retired, people went broke, people delayed families, careers, everything, because they were counting on assets that didn't perform. That's the real impact of these long sideways periods. It's not just lines on a chart, it's your life plans turned inside out. And you're right. This time we've got a political powder keg layered on top of it. The polarization has become so extreme that there are actual mainstream university polls showing 20 to 25% of both sides say violence is justified if the other side wins. 40% say it would be the end of democracy. That's not fringe. That's tens of millions of people on each side ready to light the match if things go sideways economically. Imagine coupling that with a stock market meltdown, layoffs, credit cards maxed out. Suddenly, it's not hard to picture social unrest rolling through the streets. Look what happened in Argentina. Milei basically exploded onto the scene because people were so desperate to get rid of the old decaying two-party cartel that had driven them from 7th largest economy in the world to basket case status. And they voted in a self-described anarcho-capitalist who's now tearing out rent controls, hacking away at bureaucracy. He's doing what nobody thought possible because the crisis was so bad that it flipped the entire Overton window. Argentina might just be a preview. And for the US, you've got this giant pile of personal debt coming due alongside a corporate debt maturity wall in 2025 to 2026 that nobody knows how to scale. Commercial real estate defaults already hitting. Regional banks shaky. And meanwhile, the Fed's balance sheet is still bloated from trying to paper over the last crisis. They literally cannot reload the gun to the same extent. I sometimes joke, darkly, that the only institution in America more consistently wrong than the Fed is the CBO. But you know what's scarier? Even with their laughably optimistic projections, debt service is about to overtake defense spending. That's right. We're soon going to spend more just paying interest on old debt than we do on the entire U.S. military. And after that, it overtakes Medicare, then Social Security. That's the future math. You can't grow your way out of that because we're already living in a structurally slower growth world. Demographics are turning. Productivity is soft. It's checkmate. So of course, gold and silver are sniffing this out. People keep saying to me, but Michael, why isn't gold doubling overnight if everything is so bad? And the answer is it's already moving. The entire last year and a half, we've watched gold creep from 2,000 to over 3,300. Silver is now breaking multi-decade structures. You've got the Shanghai arbitrage consistently $1 to $2 higher than Western markets, sucking metal eastward. It's a slow-motion bank run on physical metal that will only be recognized after the fact. Central banks know it. That's why they bought more gold last year than in any year since 1950. Turkey, China, India, Russia, all pulling reserves out of the dollar system. They're prepping for a world where the dollar isn't the sole linchpin. They're not guessing, they're hedging. Meanwhile, Western retail investors are still busy chasing meme stocks and hoping Nvidia bails out their 401ks. It's tragic, but also typical. Most people only run for the exits after the smoke is thick and the alarms are blaring. And as for silver, man, what a coiled spring. We're seeing exactly the kind of structural conditions that historically lead to monstrous catch-up moves. When gold makes new highs and silver hasn't yet, you know you're building potential energy, because every major monetary panic in the last century ended with silver outperforming gold by 2 to 1 or 3 to 1 on the final leg. That's what resets the ratio back toward historical norms. Vince Lancy put it brilliantly the other week. He said, "Silver is basically where gold was 18 months ago, only with more leverage and more torque." And he's right. You watch the silver chart now. You see that gigantic 45-year cup and handle base. Once it gets decisively above these low 40s, there's practically nothing on the chart until the old spike highs near $50. And with the monetary backdrop we've got, I wouldn't be shocked to see it blow right through and keep running. But the most important thing for people watching this isn't to obsess over targets. Whether silver stops at $60, $80, or shoots to $100+ in a parabolic panic is ultimately secondary. The real takeaway is, you don't want to be figuring out your insurance policy while the house is already on fire. By the time your neighbor starts bragging that he bought silver, it's too late for you to get it cheap. I saw a snarky tweet that nailed it. Gold is for when the world ends. Silver is for when the world almost ends. It's darkly funny, but there's some truth there. Silver is the volatility bet. It's where you see outsized moves when monetary trust frays, and with COMEX and LBMA inventories being drained relentlessly, at the same time the biggest players are standing for delivery instead of rolling contracts. It's not hard to connect the dots. Somebody knows what's coming. They're preparing for the unwind of the everything bubble in the only way that makes sense, by owning something tangible off the grid of counterparty risk. So what's your action plan in all this? Stay diversified but overweight the only assets that exist outside the digital casino. Have your core gold, have some silver for torque, maybe even keep some cash for opportunistic buys after volatility dislocates markets. But do not sit fully exposed to conventional paper because you think Jerome Powell or whoever replaces him has it all under control. They don't. They're the arsonists, not the firefighters. And if by some miracle I'm wrong, if somehow we magically pay down $34 trillion of debt, rebuild manufacturing, fix entitlements, get real GDP surging at 6% again, like it's the 1950s, fine. Then you'll just have a pile of gold and silver that held your wealth stable through the storm. But if I'm right, you'll be positioned on the correct side of history. I'll end with a little joke I've used before, but it fits. What did the banker say when asked if he'd ever bought gold? No, but I do have a strong portfolio of promises to pay me gold someday. That's exactly what most investors today own without realizing it. They have portfolios that only work if the promises behind them stay good. Gold and silver? Those are the assets that are the payment. So protect yourselves. The next decade is not going to look like the last. We're shifting regimes. You want to be holding real money, real assets, not promises, because at the end of the day, the math doesn't lie, even if every politician and central banker does. And when the tide finally goes out, you'll be glad you prepared.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.